Okay, so it's Tuesday, April 26th, another rough day in the market. But I wanted to make sure that I was touching base in light of what's going on. So I know the market has been very volatile. I know it's gone a lot to the downside. I know some of you are concerned. I've had many conversations. So uh, let's talk a little bit about what's going on. And if you've talked to me lately, then you've heard this story over and over. We have some things going on in our economy that we have not had in a long, long time. So you have rising inflation. In fact, inflation that we haven't seen in 40 plus years. And you have rising interest rate. You have a rising interest rate environment. The Fed is going to raise rates. They already are raising rates. So they're signaling out there that there's many more rate hikes to come. They'll probably be raising for the next couple of years. So this is a new norm for us, so to speak. So when we have this shift, and the market is shifting, this volatility that you're seeing in the markets right now is the market trying to figure out where the fair value is. Because when interest rates go up, the capital asset pricing adjusts. So multiples come down. The PE multiples come down a little bit. They get compressed as interest rates go up. So that's why you're seeing this volatility. The market is searching for a fair value based on what the Fed has said, what interest rates are doing, where inflation is, et cetera. And by the way, how strong our economy is. So it's uncomfortable, but the reality is we're really at this moment just kind of going like this, and the downsides feel much worse than the upsides feel good. I get that. It's unsettling, I know, but let's go back to where. And by the way, the market is shifting from what brought us the returns that we've seen for the past couple of years. The FAANG stocks, remember, Facebook, Apple, Amazon, Netflix, Google, those are the FAANG stocks. And so if you had not owned the FAANG stocks, they make up the majority of, over 25% of the S&P 500 index. And if you haven't owned those stocks, then you haven't made money. In fact, if you haven't owned just those stocks, you've underperformed the market. So diversification has hurt you in the past year or two. Because the S&P 500 is a capitalization weighted index, meaning the bigger you are, the more weight that company carries. And those are some of the biggest companies in the index. So it carried a lot of weight and made the index go higher. So when interest rates go up, typically the technology sector tends to go down. Why? Because the technology sector tends to have the highest PE multiples, right? And remember, so when interest rates go up, these multiples get compressed a little bit. So they have the farthest to go. They're hurt the worst during this kind of a time. So there's a shift you're seeing from the FAANG stocks. And by the way, what brought us here the past couple of years is not going to be what's going to take us where we need to go over the next year or two. Meaning technology is going to, I'm not saying Facebook or Google or any of that. I'm not saying that they're not going to make money. They're going to do fine. They're going to grow. It's just that growth is going to slow a little bit. It's not going to be the only game in town. So there's a shift going from the big technology stocks into more what we call value stocks or dividend paying stocks. So you're going to see the value stocks begin to do a little bit better than the growth stocks. By the way, small cap, mid cap, those tend to do well on the value side versus the growth side tend to do well. So you're seeing this shift go on in the market right now, and that's what's causing the volatility. At the end of the day, the only thing that matters in the stock market is earnings. That's it. It boils down to that. Everything else is headline noise, news, whatever geopolitical event is going on. They all affect the market on a day-to-day basis, but long-term, it's nothing but earnings. That's all you do. When you buy stock, what are you really buying? You're buying the earnings of that company, but more importantly, the growth of those earnings. So we still believe that earnings will be 10% or better in the S&P 500 on average in companies. You've already seen some good earnings from companies, but by the way, you've also seen some not so great earnings from Netflix, Facebook in particular. You've seen those companies report not so great earnings, and the stocks have paid the price in the stock market. So there's a shift going on. We are shifting with that. It's going to be uncomfortable. You're going to be range bound for a while. You're going to see a lot of this. And at the end of the day, again, if earnings come out the way we expect them to, there's no reason to believe that they won't. The American consumer remains strong. Yes, I know there's inflation going on out there. Yes, I know it puts a kind of a crimp on the pocketbook. But earnings of these companies will remain strong. The American consumer has a ferocious appetite for spending. We always have, and I don't really see that changing anytime soon. So as long as earnings are come in, where we expect, by the way, and we're not the only ones that expect that. We're not making this up, but if earnings come in, at 10% or better, you're going to see the stock market do okay this year. I don't think it's going to be a gangbuster year, but I think you could see, in our opinion anyway, high single digit, low double digit type returns in the market. But it's going to be kind of a long way getting there. So hang in there. If you need me, call me. I'm always available. You have my cell phone number. Most of you have my cell phone number. If you don't have my cell phone number, call the office. They're happy to give it to you, and call me if you need me. Thanks. Hang in there and make it a great day. Thanks.